Okay, welcome everyone. So we'll start our session. Okay, welcome everyone. We'll start our second lesson. During this lesson, we'll cover our LO3 and LO4, learning outcome 3 and 4. During our first lesson, we discussed about LO1 and LO2. My name is Anjum Satar. My email addresses are here in case if you need me. So please drop me email if you're not clear anything. So today lesson we'll go through LO3, be able to prepare and interpret accounting information, how we can prepare, how we can record, how we can report, and how we can interpret accounting information for making decisions which can be useful for the business. So how the user can interpret the financial information. And LO4 will discuss about be able to demonstrate specific policies, practices, and regulation with the corporate accounting. So we'll go through some regulations, some rules as well. So that will cover our LO4. So let's, before starting our lesson 2, so first we'll a bit recap, what we learned during our first lesson. Do we remember anything? What do you think we learned during our last lesson, please?
It was about more about accounting standards and the framework in which we are generating or creating our financial statements. Companies following which standards, and basically some other forms of standards which are generally accepted accounting principles as well.
Brilliant, well done. So we discuss about IAS 1, we discuss about conceptual framework, we discuss about the role of International Accounting Standard Board, we discuss about principle and rule-based approach, we discuss about during our first lesson the performance management, budget creation, business decisions, investment decisions, how we can make principle and rule based. We discuss International Ethics Standard Board. Principle is ethics and rule is the legislation or regulations which we discuss. International accounting standards we discuss. Under learning outcome we discuss about accrual concept, which also known as the matching concept. We record the transaction when the transaction happens, not on the basis of when the cash we received or the income and expenditures should be recorded on the accrual basis. Prudence we discuss, need to be the transaction prudence. Materiality we discuss. Consistency, going concern business will carry on doing business as a normal business entity, separate legal entity as a business. We can measure money measurement, stability, and objectivity. We discuss objectivities mean end result, what really we want to be and not compromise your objective. We discuss popular people chat in offices, professional behavior, professional competencies and due care, confidentiality, integrity, and objectivity, which we discuss all the professional code of ethics. Today we're moving forward and we'll discuss our learning outcome 3, which will, under this learning outcome 3, we'll discuss cash flow statement, balance sheet, and income statements. We'll discuss, how these statement and the effect in these statement affect our cash flow, and we'll discuss about intangible, government grant, research and development, how we can record in our financial statement, what are the reporting rules behind, how we're supposed to be report. If we're not reporting, what effect will be on the user and how they can interpret the information. Interpretation of, we'll discuss about some ratios. So, and learning outcome 4 is quite linked with the learning outcome 3 as well. We'll discuss accounting rule, regulation, UK standard, general acceptable accounting principle, which we already discussed, LO1 as well. Preparation company's final accounts, so I can again is analyzing, interpreting financial results. Key events such as amalgamations, accounting practices, and accounting policies. All this will go through today's lesson as well. So, any question?
Yes, sir.
Okay, we'll start our lesson. Okay, welcome everyone. We'll start our lesson 2, LO3 on LO4. My name Anju. My email addresses are here in case you need me. We are doing today's learning outcome 3 and 4. So first of all, financial reporting. So what is meant by financial reporting? So definition of financial reporting, because this unit we are doing all the reporting and reporting standard, accounting standard, how we can report so user can make the financial decision on the base of these are reporting. So financial reporting refer to the reporting of the financial activities of a business or the entity. Stakeholders of the entity or business. Stakeholders are often referred to as a user. The reports produced the user are the end product of financial reporting and accounting systems. Involve the recording and summarizing the business entity transaction. Business entity means the business transaction, a separate legal entity, so the financial activity can be reported in a format that's useful to the stakeholder. Stakeholders mean anybody who has any interest in the business is called stakeholder. The shareholders are mean the investor, those are actually owner of the business. So in order to understand the financial reporting process, it is important to consider the context and the purpose of financial reporting, why we do report, why we need to report. Because we need to report to provide the information that's useful for the stakeholder to make the financial decision. So important of financial reporting framework. If we follow the financial reporting framework, more organized system of recording the information, design of financial reporting system, how financial systems are controlled, and how to interpret the financial reports. So it's quite useful. So we need to look around, what is the control mechanism we can adopt. So during our first lesson, I mentioned you a couple of financial characteristics in financial statement. So financial statements, how many types of financial statement we prepare in accounts?
Majorly 3 or 4 types. Financial statement of financial position, income statement, profit and loss, that is, cash flows, and changes in equity.
Well done. So we prepare 4 types of financial statement. Statement of profit and loss, also known as income statement. Second statement we call balance sheet, also known as statement of financial position. Third statement we call cash flow statement or statement of cash flow. And the fourth statement is compulsory for public limited company to produce as well. Statement of change in equity is also known as shareholder statement. So all these are the 4 statements we need to be, and these are the fundamental qualities need to be in these statements. So relevant financial information regarded as a relevant if it is a capable of influence the decisions of the user. It's a relevance. Faithful representation, this means the financial information must be complete, neutral, and free from error. So faithful representation means the financial information complete, neutral, and free from error. If there not be any influence, whatever the reality, which should be okay. Enhance further these enhanced characteristic of financial statement which we need to be follow as well as accountant comparability. So it should be possible to compare an entity over time with the similar information about other entity. Entity mean the organization with the same businesses we can compare with the other businesses. We should follow the standardized, harmonized system. Verifiability, if the information can be verified through an audit, and this provide the assurance to the user the most credible and reliable. The information need to be credible, reliable. It can be verifiability. If we are saying stock, we should have a stock in our warehouse. Timeline per se, the information should be provided to the user timeline. It's not too late. So information within a time, because it's not be outdated, because otherwise it's not really influence on the decision making purposes. Understandability, the information which we can is those people have a basic understanding about accounting and finance should understand the information, and should be the language which we use that's understandable as well. Those are the users. So information should be understandable. Those might be want to review or use it. And this can be facilitated to appropriate classification, categorization, and presentation. Classification like non-current assets should be classified under non-current assets, or fixed cost, variable cost should be classified accordingly at the cost of the sale. Characterization, we can divide them across short term, long term. We can base off legal obligation, liability, current liability, and non-current liability, and we should show the information correctly. Okay, mechanism of regulatory bodies, how it's work and interpret financial reporting standards, which we'll go through. International Accounting Reporting Standard uh, Foundation, which is International Accounting Standard Board, then International Financial Reporting Interpretation Committee, and International Financial Reporting Advisory Council, and they make the reporting standard. All these, yeah. Okay, so what are their key roles are? International Financial Reporting Standard Foundation formally is known as International Accounting Standard Committee. IASC is the super, supervisory body for International Accounting Standard Board. So responsible for the governance issues and ensuring the member bodies is properly funded. Member bodies are all accounting bodies. So the principal objective are IFRS foundations are develop a set of high quality, understandable, enforceable, globally acceptable financial reporting standard, promote the use and rigorous application of those standards. Takes, like recently IFRS 16 been released, that the leases should be reflect in the financial statement, either is a finance lease or operating lease. We can categorize them, but it should be treated as, and then we can create a liability, which we'll go through further. To take in account of financial reporting needs, emerging economies like China, India, and various other small, medium-sized entities bring about national and international financial reporting standard together, work, and we can set the common rules and common grounds and provide the good information. International Accounting Standard Independent Standard Setting Bodies, IFRS Foundation, is the members responsible develop IFRS interpretations developed by the IFRS committees, and then International Accounting Standard is adopt International Accounting Standard. So these are all the role and responsibility of each IFRS, IASB, International Accounting Standard Board. Then we have an International Financial Reporting Interpretation Committee, IC. So widespread accounting issues, when we have the timely basis, they provide the authoritative guidance, and all these issues, the meetings are open to the public. And similarly, International Accounting Standard Board work closely with the national standard setter, like we have a UK national standard and international standard. So International Financial Reporting Standard Advisory Committee, AC, is the formally body of IASB and IFRS Foundation. Is range of affected and work they work, basically they just want to develop, if they have any issues, to resolve it and set the new standard if we need to. Development of international financial reporting procedure, development of international financial reporting standard. International Accounting Standard Board identify the subject and appoint advisory committee to advise on issues. If any issues we have, International Accounting Standard Board, they appoint advisory committee. Then International Accounting Standard Board publish draft, public comments, and draft versions, and then following the consideration received draft International Accounting Standard Board finally text to International Financial Reporting Standard. At any stage, International Accounting Standard Board may be issued to discuss the proper encourage comment and the publication of International Financial Reporting Standard expert. We can look around International Financial Interpretation Committee will interpret, and then of course, we can look around the 15. There are various members, 15 members, International Accounting Standard Board. Any question?
So far, sir, good, sir. No issues.
Okay, great. So next, what is all this purpose? So first, we know difference between the financial accounting and management accounting, because financial reporting firm normally under the financial accounting is concerned the publication of the financial report when external users and financial statement report director on stewardship, director of the steward, they're working on the behalf of the shareholders. So that's why we use the term in this one international accounting. So that's the main purpose of provide the right, and management is required much more detailed and up to date information for the future decision making purposes. So if we have all these information rightly recorded, that will help the management as well to make the right decision. So information flow, why is information we need, and what is the purpose, how information flow? So first of all, accounting, the flow of information, initial transaction in the financial statement. So the data is received about the transaction are relevant, and the transaction or the events is recorded in the book of Parliamentary, like the purchase day book, uh, sale day book. All these are the book of Parliamentary. Then the summarize total from the books to the prime entries, and we posted into the ledgers. Each ledger we posted the final balances, and from these of each ledger balances we can summarize to the trial balance. Trial balance should be both debit and credit side issue. If you're a bookkeeper, we are the bookkeeper, we're working up to the trial balance, and the accountant role start, the when accountant prepare the financial statement, the balances those are given on the trial balance with some adjustment if we require to do so. So the financial statements, earlier we discussed about cash flow statements, balance sheet, uh, profit and loss, and statement of share equity. All these come under the financial statement. So next we're looking IAS 7. IAS 7 is about the cash flow statement. What's come on the cash flow statement? What is the purpose of cash flow statement, which is LO3? Lot of discussion and inductive contents indicators we're supposed to discuss. Statement of cash flow. Objective of statement cash flow, we have other two statements. Those are not really 100% involved the cash transaction, but under the statement of cash flow we'll looking inflow and outflow of the cash, how much money came in or how much money went out of the business. So under the cash flow we have three major types of activities where we're looking: operating activities, investing activities, and financing activity. Operating activity mean day-to-day business. Financing, investing activity mean if we have a spare cash, we invested in the non-current asset, how much increase and decrease, where the cash being used. And the last financing activity, how much we finance to increase the cash balance, or we settle our liability. So this we need to look around. Format heading, so we need to look around reconcile and indirect, and profit and the cash. Any question?
No, sir.
Okay, next we're looking now is cash flow. Cash flow are the inflow and outflow of the cash, or the cash equivalent. Cash comprise the cash in hand, a demand deposit, or the cash equivalent, the short-term high liquid investment. They are readily converted, known as the amount of the cash which is subject to the insignificant risk of the change in the value. Operating activities are the principal revenue producing activities of the entity, which is the key business of the entity, entity mean the business or legal entity as a separate business name. They are not investing or the financing. The cash flow from the operating are the primarily derived from the principal revenue producing activity. So if we have a cash and carry business, so our primary activity is to buy things and sell it, and we can generate a revenue. So we're looking under the operating activity where the cash is came, how much cash went out of the business. So all this normally under the current asset, which is mean the most liquid asset, and how much is the change happened. So we can calculate, the cash flow from these, under the operating activities, or how much revenue we generate during the year and how much cash we receive. So all this is come under the operating activities. Okay. And investing activities are the acquisition or the disposal of the non-current asset or other investment, not including the cash equivalent. Disclosures of the cash flow arising from the investing activities, and is important because the cash flow represent the expenditure in the resource intent to generate the future income and cash flow. Okay, financing activities are activities that the result in the change in the size of com- composition of the contribute equity or borrowing. So we can raise finance through issuing more shares, or we can increase our cash by borrowing more money from the banks or through loans or selling through various assets. So that's different, the financing method we can use. That's all come under the financing activity. Any question?
All right, sir.
Okay, next we're looking non-current asset. What is meant by non-current asset? Non-current asset mean the long-term asset is known as with the short abbreviation NCA, non-current asset, and should be carried at the lower. According to standard, we need to be always record the transaction on the lower the cost or net realizable value. So always we in the asset we need to be find the carrying value, how much is the net book value we have in. So how much is the asset being depreciated the date when we purchase it under IAS 16, which is International Accounting Standard 16. So property, plant, equipment are non-current asset. Receivable amount, how much is amount we can receive by selling this, greater of if the fair value is mean the market value less cost to sell, and if the greater, whichever is the greater value in use, so we record the transaction on the basis of these things. So we need to be look around always. So next, any question?
No, sir. Fine with the impairment.
Okay, sorry, which one?
I think impairment is okay. We can move on, sir.
Okay, brilliant. So we do sometimes look around the asset need to be impaired or not. So IAS 20 government grant, how we can treat the government grant according to our learning outcome. We need to look around two types of the grant we can divide under two: revenue grant and the capital grant. Capital grant is when you need to buy infrastructure, and the revenue grant which you related to meet the day-to-day expenses. So revenue deduct from the related expense and shows as a credit in the statement of profit and loss. So if we have a more or receive revenue from the government and we deduct our expenses, and we can have a profit will show in the statement of profit and loss, and expenses goes in the statement of profit and loss as well. If we have a capital, we are the money being given government grant to buy machines or in set up infrastructure written off against the cost of the asset, which we can write off and treat as a deferred income in future if we have a success profit, so we can generate some future income. So that's all about IAS 20 government grant. So we can, in our discussion, we can include what is the IAS in just a bit, which I already sent you some resources. So we need to go through these, further, and please, in your assignment, you need to include a bit, discussion IAS. Oh, IS 38. What is the IS 38? International Accounting Standard 38. Intangible assets.
Mhm.
Intangible mean anything which don't have a physical substance, we can't see it, we can't touch it, can't feel it, we call it intangible. So we
Yeah.
need two types of goodwill can be internally generated, goodwill are intangible asset can be purchased. So when we are buying other companies, we are paying money, their net asset, for suppose is 100,000, we are paying 120,000. Why we are paying 120? 20,000 we are paying extra due to their goodwill. So purchase goodwill is quite easy. We can capitalize in our book of account as a goodwill. So
Mhm.
finite life, indefinite life, and we need to be amortize our impairment review. We need to do because the good will carry on increasing or decreasing. So impairment means the loss. If we have a loss, so we should reduce the value of the goodwill in our, and the losses will go in the profit and loss.
Right, sir.
Internally generated goodwill, it's very difficult internally goodwill generated goodwill because asset definition is anything which will flow the future economics benefit or anything which will give us future economics which we call asset, which we
Mhm.
own it, which will go give us. So if internally we generate asset, how will measure this will give us future economics benefit? Because it's quite difficult to be decide, how much future economics benefit we can get through this asset. So if we can measure reliably, then we can include internally generated. So how we can decide how much we need to be? So research and development. If we are spending money on research, if it's the research stage, not at the development stage, research is considered as expense. If it's a develop like GlaxoSmithKline, they develop the formula, they spend a lot of money on the research. The research we can't, but the development no, from this research when we reach at the development stage we can make the medicine, and the medicine the development stage if we have an infrastructure we can produce the medicine and which is tested, that will be this will give us future economics way which we can do business with it, which can be benefit for the public, and we can generate revenue from it. It's called the development stage. Now we can capitalize if the criteria met. So that's the criteria. So we can include that the development cost, which we spend money on the development in our balance sheet as a goodwill. Any
Mhm.
question?
All right, sir.
Okay, next we're looking research and development criteria. So recognition criteria, probably flow of benefit, intention to complete the project, reliably measure of the cost, adequate resources. We have resources to make the medicine. We have a people, we have machine, we have a raw material, so we can say, okay, that's fine now. We can include in our statement. Technically feasibility. Some company maybe they develop, they have a knowledge, they are the development stage, but they don't have a technically feasibility to do something. So we can't include as a goodwill in our book of account because we don't have a technical. Expected to be profitable. If we are expected to be profitable, then we can include in future. Okay. Any question?
No, sir.
Okay, next we're looking interpretation is also known as a ratio analysis, how we can interpret information and in term of the user we discuss in other unit as well. So ratios is a comparison of two numbers where we can calculate the ratios and ratios are what's happened last year, this year. So return on ROC, return on capital employed, return on equity, ROE. We can look around asset turnover, how much is the asset turnover we have, how much per pound generate our revenue. So gross profit, sales minus cost of sales equal to gross profit, the percentage which we can use, operating profit, and other ratios we can calculate the liquidity ratios, how much is the asset liquid current ratio divided by current liabilities. We can calculate. Gearing ratios, we can calculate. The gearing is mean high gear, high risk ratios, which we discuss. Use of resources, trade receivable, trade payable days, those we can calculate, which is also known as efficiency ratio. So all these ratios, we need to interpret the information, how we can use effectively and measure the performance of the organization. So that will help the user and the stakeholder to make the effective decisions to in future, so we can get more economics benefit. Any question?
All right, sir.
So I'm not going through in ratios, but I'm just demonstrating interpretation, mean ratios, the interpretation which we can use it. Okay,
Yeah.
regulatory framework, which we discuss is your LO4 is a lot of based on regulatory framework. Regulatory
Mhm.
framework for preparation financial statement necessary for a number of reasons to ensure the needs of the user financial statement are met, least the basic minimum information to ensure that all information provided in the relevant economic arena is both comparable and consistent. Given the growth in the multinational company and global investment arena, increase in international one, and increase the user and the confidence in the financial reporting process, and regulate the behavior of the company and directed toward the investor. So financial reporting standards on their own would not be sufficient to achieve these aims. In order, there must be legal and market-based regulation. So depends, So national regulatory framework for financial reporting. Here we're discussing more about the UK regulatory framework. There are the many elements regulatory environment of accounting. Typical regulatory structure can be national financial reporting standard, national laws which govern market regulation, market conduct authorities, market ombudsmen, and those, various other watchdog. Those are look and monitor and security exchange rules. For example, the UK has own national financial reporting authorities, the Accounting Standard Board, financial reporting accounting for companies act. However, there are also many pieces of UK and EU, even US legislation, Servants, that's the reports. So that's the reports really we need to look around. So we need to carry on. Okay. So okay. Anybody any question? Okay, so we'll go through now. Okay. Anybody any question? If you have any question? Okay, next now we looking, okay, Company Act 2006, we need to be well aware of UK, all other reporting standard, London Stock Exchange or various other regulatory standard. So, okay, so next we're looking the development of accounting standard. Accounting standard is a set of the rules which prescribe the method by which the financial statement should be prepared and present. So UK standard SAP's Statement of Standard Accounting Practices, FRS Financial Reporting Standard, in internationally IAS, IAS2 Inventory Valuation. IAS is a worldwide, and the UK and worldwide standard broadly is similar with some differences in terminologies. So it's not really their ATHE is a separate qualification, but assessment are using IFRS, International Financial Reporting terminologies which we can use. So these are the accounting standard which we can discuss to address the learning outcome for. Okay, so IS 37 provisions. So sometime it's called contingent. contingent liabilities. That, like, think about the case against the Facebook, and still in the European Court of Justice, but the likelihood of more than 60%, this case will be against the Facebook. So Facebook should show in the financial statement probable. So because likely will be happen, so
Mm.
provide liability should be provide, and contingent, if the asset is a contingent asset, should be disclosed in the book of account. So possible contingent liabilities, if maybe happen or not, still we need to disclose in the notes under the in the balance sheet under the additional information. So if is possible under the asset, do nothing, we don't need to be remote. If is less likely, less than. If is a more than 50%, less than 50%, less than 20%, so we need to be follow these rules. Any question here?
No, sir.
So next we're looking the statement of profit and loss. How statement of profit and loss look like? Sales revenue come at the top, less the cost of sales. What make cost of sales? Opening inventory plus purchase less closing inventory. That's equal to cost of sales. Gross profit less expenses. If you minus all other expenses, we'll get the profit for the year. So that's really we need to be followed. Okay. Next, balance sheet, how we can structure the balance sheet. Always at the top, the company name, the year end, and then balance sheet provide the information about asset, liabilities, and capital. So if we'll calculate the ratios last year, this year, the difference between, and we can categorize the ratios into four. We can interpret the information which is given in these statements for the future economic decision purposes. So these are all, which we supposed to be addressed in our learning outcome 3. Our discussion supposed to be related to our learning outcome 3 and 4, which is all about. We'll a bit recap, and we'll go back to our actual what we're supposed to learn under 3 and 4. So we'll a bit, recap. So then we'll move to, okay. So if any keywords left, under learning outcome 3. Under learning outcome 3, we discuss about the cash flow statement, changes, investing, financing, and activity. We discuss about non-current asset, which is a long-term asset. We can use more than 12 months. Intangible, I mentioned you, the goodwill is intangible asset. Government grant, we discuss grant can be under the revenue or the capital, and we can spend it. If it's the revenue grants, we should show in the profit and loss. If it's other is, we can look around. So then next, research and development. Research can't be, but the development is the stage we can treat as an asset. It is a criteria we need to meet, it will flow the future economics benefit. Accounting for taxation we need to include, and we need to follow the standard as well on accounting IAS 10. Including the deferred taxations, like the future tax which we defer, we will pay. For the long-term contract, we need to look around. The contract can be contractual agreement between organization. That's why IFRS 16 is we need to be leases have a two-type: finance lease and operating lease. A lot of companies they not used to show operating lease, how long they have a lease, how long they have a commitment, how long they have a contract. Contract is a legal obligation between two parties, and acquisition basis we can look around the goodwill, non-controlling interest which we don't have a contract. When we acquire the company, it's consolidated. When we take over, so parent company have a right to, and the other company non-controlling interest, we don't have 100%, but we have a control on it. So which we a bit, IFRS 3, International Financial Reporting Standard 3 is addressed. So which is I already uploaded. There is a book as well, so if you want a bit study background as well, you can. But if you have any questions, so please ask me. Comprehensive income, I showed you. Profit and loss, issue, redemption of shares, share issues, we can redeem, we can buy back, we can sell it. So all about the share. Liquidation, which I mentioned you, the companies liquidate. Gearing ratios is a help to measure how much is the risk there. It can be leads to the liquidation if we have a high gear ratio. interpretation, which we discuss financial ratios, accounting standard, UK we discuss SAPs, and we discuss about what legislation in the UK we need to be follow. Company Act we mentioned different watchdog or regulatory or market acts we need to be follow as well. We discuss about again the final account statement of income statement, balance sheet, cash flow, and I already mentioned you. So what is analysis purposes? Well, commissions the companies and accounting practices and policies which I mentioned, your prudence, going concern, materiality, significance, all these really policies and procedures and the qualitative characteristic of financial statement we need to be follow and we must need to be reports to address. So today we address about our LO4. So so today we address our LO3 and LO4, be able to prepare and interpret and demonstrate specific policies and practice and regulation which I mentioned you. Some of so please you can discuss in your assignments if you have any question. So ask me and I'll get back to you as soon as possible. Hope so. I'll speak with you all and we'll start from next week our new unit. So please try to join the sessions and otherwise carry on doing your assignment. If you have any question, drop me. Thank you for watching or participating, and we'll speak you some point. Thanks. Bye bye.